Warren Buffett sits in his modest office in Omaha, Nebraska, surrounded by decades of financial wisdom. At 94 years old, the Oracle of Omaha has witnessed every market cycle, every bubble, every crash that has devastated fortunes across generations. His net worth exceeds $140 billion, built not through luck, but through disciplined avoidance of financial traps that have destroyed countless investors. Today, his warning rings louder than ever before. The investment landscape has transformed into a minefield of sophisticated traps designed to separate people from their money. What makes this moment particularly dangerous is that these destructive investments don't announce themselves as threats. They arrive wrapped in promises of quick wealth, revolutionary technology, and guaranteed returns. They seduce through social media influencers, prey on fear of missing out, and exploit the gap between what people want to believe and what actually works. Warren Buffett's investment philosophy has always centered on one fundamental principle: avoid permanent loss of capital. While others chase the hottest trends, Buffett focuses on what not to do. His billions weren't built on spectacular wins, but on systematically avoiding spectacular losses. This distinction separates wealth builders from wealth destroyers. The first investment that will destroy financial futures is the cryptocurrency casino that has captured millions of participants worldwide. Warren Buffett has called Bitcoin rat poison squared and described the entire crypto market as a combination of gambling and fraud. The numbers tell a devastating story. Since Bitcoin's peak in November 2021 at $69,000, over $2 trillion in crypto market value has evaporated. Millions of everyday investors, convinced they were early adopters of revolutionary technology, watched their savings disappear overnight. The cryptocurrency trap operates through several psychological mechanisms that Buffett has spent his lifetime warning against. First, it offers the illusion of getting rich quickly, without producing anything of value. Bitcoin doesn't manufacture products, provide services, or generate cash flow. Its entire value proposition rests on the hope that someone else will pay more tomorrow than what investors paid today. Buffett calls this the greater fool theory, and history shows it always ends badly. Second, crypto investments exploit technological FOMO. The blockchain terminology, decentralization promises, and complex technical jargon create an aura of sophistication that masks fundamental emptiness. Warren Buffett's famous advice applies perfectly here. Never invest in something one doesn't understand. Most crypto investors cannot explain how blockchain actually works, yet they risk life savings on it. Third, the crypto market lacks the fundamental safeguards that protect traditional investors. No earnings reports, no cash flow statements, no regulatory oversight, no intrinsic value calculations, just price movements driven by sentiment, manipulation, and speculation. Warren Buffett has repeatedly emphasized that investing should be based on analyzing businesses, not betting on price movements. The human cost of crypto speculation extends far beyond numbers on screens. Families have lost homes, retirements have been decimated, and young people have squandered years of savings chasing digital tokens with no underlying value. The promise of financial freedom through cryptocurrency has delivered financial devastation instead. Warren Buffett's second warning targets the meme stock phenomenon that has convinced millions of retail investors that coordinated speculation can overcome fundamental business reality. Companies like GameStop and AMC became vehicles for social media-driven price manipulation, where the goal wasn't investing in business fundamentals, but creating short squeezes and riding momentum. The meme stock mentality represents everything Warren Buffett has spent his career opposing. Investing becomes gambling. Research becomes irrelevant. Long-term value creation gets replaced by short-term price manipulation. The Reddit forums and social media groups promoting these stocks create echo chambers where critical thinking disappears and herd mentality dominates. What makes meme stocks particularly destructive is their corruption of proper investment principles in young minds. An entire generation of new investors learned that market success comes from following internet crowds rather than analyzing businesses. They learned to mock fundamental analysis, ignore profitability, and celebrate losses as loyalty to the movement. Warren Buffett teaches that successful investing requires patience, discipline, and focus on business fundamentals. Meme stocks teach the opposite: impulsiveness, speculation, and attention to price movements. The long-term consequences of this educational destruction will ripple through decades as these investors carry flawed mental models into their financial futures. Buffett's wisdom about knowing what one owns applies perfectly here. Meme stock investors cannot answer basic questions about the businesses they're speculating in. What's the company's competitive advantage? What's their path to profitability? What's their 5-year business plan? These questions don't matter in meme stock culture, which is precisely why that culture destroys wealth. Now, those who've been following this journey into Warren Buffett's warnings understand something critical. The difference between wealth building and wealth destruction often comes down to having the right information at the right time. Just as Warren Buffett avoided the traps that destroyed others, smart investors surround themselves with sources of genuine financial wisdom. Those who want to continue receiving these insights into what the world's greatest investor would say about protecting wealth should ensure they're connected to channels that cut through the noise and deliver truth. The subscribe button represents more than just clicking. It represents choosing knowledge over ignorance in financial decisions. The third destructive investment Warren Buffett warns against is penny stocks and micro-cap companies that promise explosive growth but deliver spectacular losses. These stocks trade for pennies per share, creating the psychological illusion that investors are getting more for their money. 1,000 shares sounds impressive, even if those 1,000 shares are worth only $100. Penny stock promoters exploit mathematical illiteracy. They highlight that a stock moving from 50 cents to $1 represents a 100% gain, making it sound easy to double money. What they hide is that penny stocks trade at those prices because the companies behind them are fundamentally broken. Poor management, unsustainable business models, accounting irregularities, and outright fraud run rampant in the penny stock world. Warren Buffett's approach to investing emphasizes quality over price. He would rather buy wonderful companies at fair prices than terrible companies at cheap prices. Penny stocks represent the worst version of the opposite philosophy. Buying garbage because it's on sale. The companies don't produce profits, don't have competitive advantages, and often don't have legitimate businesses at all. The penny stock world is riddled with pump-and-dump schemes where insiders accumulate shares cheaply, promote the stock through misleading information, and sell to unsuspecting retail investors who buy near the peak. By the time average investors discover these companies, the insiders are already planning their exit, leaving newcomers holding worthless shares. Statistical reality destroys the penny stock dream. Studies show that over 90% of penny stock investors lose money. The few spectacular success stories get amplified and shared, while the countless disasters remain silent. This survivorship bias creates a false perception of opportunity where only risk exists. Warren Buffett's fourth warning addresses one of the fastest-growing wealth destroyers, day trading and leveraged trading platforms that promise anyone can become a professional trader from their smartphone. The apps make trading feel like gaming, complete with confetti animations when trades are placed and simple interfaces that hide the complexity of what's actually happening. The day trading trap operates on a fundamental mathematical principle. The more someone trades, the more they pay in fees, spreads and taxes, which dramatically reduces returns even before accounting for bad decisions. Warren Buffett has repeatedly emphasized that his favorite holding period is forever, while day traders measure success in minutes or hours. Leveraged trading amplifies both gains and losses, and for average investors, it consistently amplifies losses. Platforms offering 10x, 20x, or even 100x leverage essentially hand retail investors a loaded weapon pointed at their own financial futures. When markets move against leveraged positions, the losses can exceed the entire account value, leaving traders owing more than they invested. The psychological damage of day trading extends beyond financial losses. The constant screen watching, emotional roller coaster of wins and losses, and addiction-like behavior patterns destroy mental health while destroying wealth. Studies show that day traders perform worse than random chance after accounting for fees and taxes. Warren Buffett's approach to markets is the opposite of day trading. He studies businesses, buys ownership stakes in great companies, and holds them for decades. He ignores daily price fluctuations, focuses on long-term business performance, and lets compound interest work its magic. Day trading represents the complete inversion of this proven strategy. The fifth destructive investment category encompasses all forms of get-rich-quick schemes, from multi-level marketing to real estate flipping courses to forex trading systems. These schemes share common characteristics. They promise easy money, require upfront investment, and deliver profits primarily to those selling the dream rather than those buying into it. Warren Buffett's life demonstrates that building real wealth requires time, patience, and disciplined accumulation of productive assets. He started investing at age 11 and has been compounding wealth for over 8 decades. His billions came from owning businesses that produce value, not from shortcuts or secrets. Multi-level marketing schemes convince people they're building businesses when they're actually just becoming unpaid salespeople in someone else's pyramid. The mathematics of MLM structures ensure that the vast majority of participants lose money, while a tiny percentage at the top profit from the losses of those below them. Real estate flipping courses promise anyone can make millions buying, renovating, and selling properties. What they don't mention is that successful real estate investing requires substantial capital, deep market knowledge, construction expertise, and the ability to survive market downturns. The course sellers make their money from course sales, not from flipping houses. Forex trading systems claim to have discovered patterns or algorithms that beat the most sophisticated hedge funds and institutional investors. If such systems actually existed, the creators would use them to become billionaires rather than selling them for a few $1,000s to random internet users. Warren Buffett's sixth warning targets investment products with excessive fees that silently destroy wealth over time. High-fee mutual funds, expensive financial advisors, and loaded investment products take such large chunks of returns that investors would be better off in simple index funds. The mathematics of fees are brutal over long time periods. A 1% annual fee might sound small, but over 30 years it can reduce final wealth by 25 to 30% compared to a low-cost alternative. A 2% fee can cut wealth by over 40%. These aren't small differences. They represent hundreds of thousands or even millions of dollars for typical retirement savers. Warren Buffett has famously advocated for index fund investing precisely because it eliminates high fees while delivering market returns. He made $1 million bet that a simple S&P 500 index fund would outperform hedge funds over a decade, and won decisively. The hedge funds charged 2% management fees plus 20% of profits, yet still underperformed the simple low-cost index approach. Financial advisors who charge percentage-based fees create perverse incentives. They profit from keeping clients invested in actively managed funds that generate commissions, rather than recommending low-cost index funds that would be better for clients. Insurance products like variable annuities come wrapped in layers of fees that benefit sellers far more than buyers. Warren Buffett teaches that investors should know exactly what they're paying in fees and demand that those fees be justified by superior performance. Most expensive investment products cannot justify their costs, which means they're simply transferring wealth from investors to financial intermediaries. Those who have absorbed Warren Buffett's warnings this far understand something essential. The journey from financial ignorance to financial wisdom requires constant learning and exposure to truth. Warren Buffett didn't become the Oracle of Omaha by accident. He spent his life reading, studying, and learning from mistakes both his own and others. The investors who thrive are those who build knowledge systematically, who surround themselves with information sources that challenge conventional wisdom and reveal dangerous traps before they spring shut. Ensuring connection to channels that deliver this level of insight isn't optional for those serious about building lasting wealth. It's fundamental to financial survival. The seventh destructive investment Warren Buffett warns against involves timing the market rather than spending time in the market. Countless investors have destroyed their wealth trying to sell before crashes and buy before rallies, when historical data shows this approach consistently underperforms simple buy and hold strategies. Market timing requires being right twice, correctly predicting when to sell and correctly predicting when to buy back in. Studies show that even professional investors cannot consistently time markets successfully. For average investors, the odds of success are even lower, yet the confidence in their ability to beat these odds remains irrationally high. The cost of missing the best market days is staggering. Research shows that missing just the top 10 trading days over a 30-year period reduces returns by more than half. The problem is that these best days often come immediately after the worst days, meaning market timers who sell during downturns miss the subsequent recovery. Warren Buffett's famous quote applies perfectly here. The stock market is a device for transferring money from the impatient to the patient. Market timers are the epitome of impatience, constantly trying to optimize entry and exit points rather than simply owning great businesses for long periods. Behavioral finance research reveals that humans are psychologically programmed to make terrible market timing decisions. Fear peaks at market bottoms when investors should be buying, and greed peaks at market tops when investors should be cautious. By trying to time markets, investors amplify their psychological weaknesses rather than neutralizing them through discipline. The eighth warning from Warren Buffett addresses speculation in options, futures, and derivatives that offer leverage and complexity far beyond what most investors can handle. These instruments were designed for sophisticated hedging strategies by institutional investors, but have been democratized through apps that make them accessible to anyone with a smartphone. Options trading has exploded among retail investors, particularly through platforms that gamify the experience. Young investors treat options like lottery tickets, buying far out of the money calls, hoping for quick fortunes. The statistics are brutal. The vast majority of options expire worthless, transferring wealth from hopeful buyers to sophisticated sellers. The complexity of options creates an information asymmetry that favors professional traders over retail investors. Concepts like implied volatility, Greeks, theta decay, and strike selection require years of study to understand properly. Yet apps present options trading as simple directional bets, hiding the mathematical reality that options are probability games where the house advantage is substantial. Warren Buffett himself has called derivatives financial weapons of mass destruction and largely avoids them despite his sophisticated understanding. If someone of Buffett's intelligence and experience treats derivatives with extreme caution, what chance do average investors have of using them successfully? The leverage embedded in options and futures means small market moves can wipe out entire accounts. Stories abound of young traders discovering they owe hundreds of thousands of dollars after option strategies went catastrophically wrong. The easy entry into these instruments masks the devastating exit possibilities. Warren Buffett's ninth warning concerns investing based on tips, rumors, and hot stock recommendations from unreliable sources. Social media has amplified this problem exponentially, with influencers promoting stocks they're paid to promote, anonymous accounts spreading misinformation, and echo chambers reinforcing bad ideas. The investment world is filled with conflicts of interest that make most tips worthless or actively harmful. Financial media needs to generate content constantly, so they hype stocks that make exciting stories rather than boring businesses that compound wealth reliably. Social media influencers get paid for engagement, so they promote controversial positions and dramatic predictions rather than sound advice. Warren Buffett's approach is the opposite. He does his own research, studies businesses thoroughly, and makes independent decisions based on fundamental analysis. He ignores market chatter, doesn't care about short-term price movements, and focuses exclusively on long-term business quality. The danger of tips is that they create a gambling mentality where investors are constantly looking for the next big score rather than building systematic wealth. They jump from one hot stock to another, always convinced that this time they've found the secret, while their portfolios underperform simple index investing. Reliable information costs money and time to produce. Free stock tips are almost always worth exactly what investors pay for them: nothing. The people giving away free investment advice are either selling something else or trading against the positions they're recommending to others. Warren Buffett's 10th warning addresses the trap of investing in businesses one doesn't understand, even if those businesses are trendy or recommended by smart people. The temptation to invest in AI stocks, biotech companies, or emerging technologies that one cannot properly analyze has destroyed countless portfolios. Buffett famously avoided technology stocks for decades because he didn't understand their competitive dynamics well enough to predict long-term outcomes. He missed opportunities but also avoided disasters. Only after thoroughly studying businesses like Apple did he make major technology investments. The circle of competence concept is central to Buffett's philosophy. Investors should stay within areas where they have genuine expertise and understanding. Expanding that circle requires years of study, not wishful thinking or fear of missing out. Complex businesses can hide problems that destroy value. Simple businesses that anyone can understand are far more likely to deliver predictable returns over time. Buffett built billions by investing in insurance, banking, consumer goods, and other businesses with straightforward economics. The pressure to invest in trending sectors creates a dangerous dynamic where investors violate the understanding principle because everyone else is doing it. This herd behavior leads directly to bubbles and crashes as money floods into areas without proper analysis. Now, as this journey through Warren Buffett's warnings nears its conclusion, a pattern emerges. Every destructive investment shares common characteristics: complexity over simplicity, speculation over investing, shortcuts over discipline, and emotion over analysis. The investors who will thrive in coming decades are those who internalize these lessons now, who choose boring consistency over exciting gambles, who build knowledge rather than chase tips. Those committed to this path understand that surrounding themselves with sources of genuine financial wisdom isn't just helpful, it's essential. The subscribe button represents a decision to reject the noise and embrace the signal, to choose Warren Buffett's tested principles over social media's latest fad. The final and perhaps most destructive investment is no investment at all. Paralysis from fear, confusion from information overload, or procrastination, disguised as being careful, prevents millions from building wealth through simple, time-tested strategies. Warren Buffett started investing at age 11 with money from a paper route. He didn't wait for perfect knowledge or ideal conditions. He started with what he had and learned along the way. The cost of waiting to invest is staggering when considering compound interest. A 25-year-old who invests $500 monthly until retirement at 65 will accumulate over $1.2 million at conservative returns. A 35-year-old who invests the same amount will accumulate only about $500,000. That decade of delay costs $700,000, the price of overthinking instead of acting. Fear of losing money prevents people from gaining wealth, yet they're losing guaranteed purchasing power to inflation every year their money sits in checking accounts earning nothing. Warren Buffett teaches that the greatest risk is not taking enough risk, that the safest long-term investment is a diversified portfolio of productive assets held patiently. Information paralysis affects intelligent people most severely. They consume endless content about investing, read countless books, watch hours of videos, yet never actually invest. They mistake consumption of information for action, preparation for progress. Warren Buffett's advice cuts through this. Start with index funds, invest consistently, ignore the noise. The perfect investing strategy doesn't exist. The perfect time to invest never arrives. The complete understanding before starting is impossible. What separates wealth builders from the broke is action despite uncertainty, consistency despite volatility, and faith in the long-term power of capitalism despite short-term chaos. Warren Buffett's life demonstrates that building extraordinary wealth requires ordinary virtues: patience, discipline, consistency, and humility. His warnings about destructive investments aren't complicated or sophisticated. They're simple principles that humans violate repeatedly due to greed, fear, and the eternal hope that this time will be different. The investors who avoid these traps won't become billionaires overnight. They won't have dramatic stories of quick fortunes or exciting wins. But they also won't have stories of devastating losses, of retirement dreams destroyed, or of years wasted chasing illusions. They'll have something better: steadily growing wealth built on solid foundations that compound into genuine financial security. Warren Buffett's warnings come from a place of deep understanding of both markets and human nature. He knows that the biggest threats to investor wealth aren't market crashes or economic recessions. They're the psychological vulnerabilities that lead intelligent people to make repeatedly destructive decisions. He knows that protecting wealth requires protecting oneself from oneself. The choice facing every investor is simple but profound. Follow the herd into destructive investments wrapped in attractive promises, or follow the boring path that has reliably built wealth for generations. Chase excitement or build wealth, speculate or invest. The outcomes of these choices compound just like returns, creating either escalating prosperity or deepening financial despair. Warren Buffett issues these warnings not as abstract theories, but as battle-tested wisdom from someone who has navigated every market condition for nearly a century. His warnings work because they're based on unchanging principles of value, on mathematics that cannot be circumvented, and on human psychology that repeats across generations. The investors who listen and act on these warnings won't just avoid disasters. They'll position themselves for the steady wealth accumulation that transforms lives and builds legacies.